Well, hello, ladies and gentlemen, and welcome again to our 6-minute video series where 6 minutes can save you hundreds of thousands of dollars in capital gains taxes and earn substantial income for you for the rest of your life. Hi, my name is Joe Metz. I'm a real estate broker and financial advisor to senior homeowners and landlords, and we've got the perfect retirement solution for landlords and a way for you to avoid the capital gains tax on the sale of your personal residence while converting it to substantial monthly income. This is episode 20. We're going to be talking about the pros and cons of triple net leases, also known as STNLs, and why buy them? Control. So before we get into that, you may know us from the newsletter that you get called the Senior Homeowner Times, books that we've published called Best Cities in the West, Senior Housing Simplified, Help at Home. And to get any of those, just call that number or go to that email address there. And lots of stuff on our website as well. For our latest book called Avoiding the Capital Gains Tax, just call that number there. Okay, and again, standard legal disclaimer here. This information is for educational purposes only. Please consult your own professionals before engaging in any of these strategies. So we are your one-stop shop. There are a lot of people that do pieces of what we do, but we do it all for you. So when it comes to retiring from real estate and getting into properties that are going to give you solid income and the avoidance of the capital gains tax, this is where you come. And we do it all for you. You pay us nothing extra for our services. We get paid by the top realtors that we help you find to list your house. So what is an STNL? An STNL is a single tenant net lease property, a commercial property that consists of one building leased by one tenant. There are lots of them out there, but they're not all equal. And we only recommend and sell those with high credit tenants, long-term leases, absolute net leases, meaning that the tenant's responsible for all the maintenance and repairs, with a rent guarantee by a solid parent corporation, and in growing locations with low crime rates. So when you exchange your rentals for a guaranteed passive income, you might buy a Bank of America building priced at, say, $4 million. That'll provide you $200K in annual income net and management free. Or a Chase Bank, price $5 million, $250,000 a year net to you. And or a Burger King, priced at $2.2 million with $110,000 income. Or a 7-Eleven, priced at $2.9 million with income of $145,000 a year. So, in other videos that we do that we talk a lot about REITs and DSTs. Well, here's the pros and cons of STNLs versus those. When you own a REIT, you own a fractional interest in a lot of properties. Your capital is highly diversified. So there's one big benefit with a REIT, highly diversified. The downside is that you have zero control, almost, and all decisions are made by others. Your investment has limited liquidity and you can't borrow against it. When you own an STNL, however, you're the only owner. You have complete control in what you buy, where you buy, and when you sell it. And you can also take tax-free cash via a loan at any time during your ownership. But when you buy either a REIT or an STNL, you're going to, one, retire from active property management. You're going to get rid of the 3 T's, the tenants, the toilets, and the turnovers. And as we get older, dealing with a vacant house, getting it ready to rent, finding a new tenant can be a royal pain. You don't need this anymore. You can avoid the capital gains tax of hundreds of thousands of dollars, sometimes over $1 million, and double your rental income in the process in most cases. For example, let's say you own a house worth $3 million and you're renting it at $6,000 a month. Well, after you pay your taxes, insurance, property management, maintenance, etc., your total expenses are only 48, I'm sorry, your total income is only $4,800. That's only a 1.92% return on your $3 million equity. Take that $3 million and put it into a STNL like a Starbucks coffee, for example, and now your income goes from 57,600 to $150,000 a year, or from 4,800 a month to 12,500 a month. Same thing with a REIT. So I'm not knocking REITs. REITs are good too, but we're talking about STNLs today. Now, if you would ever like to understand how much you are making on your current investment, your current property, and what what that return could be. For example, will your income double? Here's our handy little estimator. It not only estimates what your income will do, but it also estimates what your capital gains tax might be should you sell the property instead of doing a 1031 exchange. You can see in this case, your income return on equity is only a 1.91%. Well, it'll go to 5% with an STNL or a monthly income of 11,750. It's almost a triple there, right? And if you sold your property, your capital gains tax would be $917,000. Don't want to write that check. So any questions, give us 24 hours to reply. Just email your questions to this email address that you're getting this from. Or if you'd like to discuss your own unique situation, call us at this number here or book me in my calendar at cgt1.com. Thank you for your time today. And if you want the whole enchilada, where we talk about the REITs, we talk about the pros and cons of REITs, and how you sell your property, and our whole process for engaging this strategy for you, then come to our next complete presentation, which will be on Wednesday, June 11th at 5 o'clock. Don't miss out on that. You can register by calling that number or go to conquercgttax.com. So I want to thank you for watching the video today. And if you have any questions or you'd like to talk with us about your own unique situation, call us at 650-758-0319 or email us at info@seniorhomeownersolutions.com. Thank you and have a great day.